Your tax returns play a huge role in whether you get approved for a mortgage, and yet so many people misunderstand how lenders actually review them. Whether you're a W-2 employee, self-employed, or somewhere in between, I'm going to walk you through exactly what lenders look for and how to make sure your taxes don't hold you back from buying your dream home. And by the end of this video, you'll have the clarity and the confidence to navigate this part of the process. Let's get started. How lenders analyze your tax returns and supporting documents. Lenders use tax returns to verify certain types of income and assess IRS debt obligations. Key forms reviewed include W-2s, 1099s, Schedule C, Schedule E, and K-1s for business owners. For self-employed borrowers, lenders often average qualifying income from the last 1 or 2 years of tax returns to determine the income stability, depending on the program guidelines. Common tax pitfalls that can hurt mortgage approval. Claiming excess write-offs. This reduces your taxable income, but also the income and profits that lenders count towards your mortgage. Having a declining income with large year-over-year swings more than 20% can raise red flags. Undocumented side income is nice to have, but unfortunately, cash income not reported doesn't help your qualification for conventional or government loan programs. If you owe back taxes, the associated payment plans can impact your debt-to-income ratio and the amount that you can get approved for. How to optimize your tax documents before applying for a mortgage. For W-2 employees, keep the last 2 years of W-2 forms ready and available. For self-employed borrowers and rental property owners, work with an accountant or tax advisor to balance your deductions and reported income and profit. Minimize write-offs in the year leading up to applying. What about tax refunds or tax liabilities? A tax refund can be used for your down payment and closing costs, but it doesn't count as regular income. Owing tax from previous filings, it's treated as a debt and affects your DTI calculation. So you want to pay off or manage liabilities to the IRS before applying for your loan. How to handle tax documents for a smooth mortgage approval. Use the IRS Get Transcript service to verify your IRS transcripts match the documents that you've submitted to your lender. If you're self-employed, I'd recommend maintaining an updated profit and loss or P&L statement alongside your tax filings, which is required for certain loan programs. Proactively plan tax strategies as early as possible before starting the mortgage application process. Keep in mind, there are non-QM loan programs which do not use your tax returns and instead rely on bank statements and profit and loss statements. So if you don't qualify based on your tax returns, you still have options to get a loan. Taxes can be confusing, but when it comes to getting approved for a mortgage, being proactive makes all the difference. If you're planning to buy a home soon, now is the time to get your tax documents in order. And if you have questions, reach out to me. I'd be happy to help. If you found this video helpful, be sure to watch my next video on how to find the right homeowner's insurance. It's packed with tips to save you time and money.